Good afternoon, everyone. Thank you so much for joining us as we host our NC LEAP webinar on wage and hour compliance. I am excited to introduce to you Michael Cohen. Michael Cohen is an attorney with Ogletree Deakins, practicing employment law, specifically wage and hour compliance for employers. Michael has extensive experience defending clients in federal and state courts nationwide and has been recognized every year since 2018 as a North Carolina Rising Star attorney. So with that being said, I will hand it over to Michael.
Thank you, Carson, and good afternoon, everybody. Thank you for being here today. As Carson mentioned, my name is Michael Cohen. I'm an attorney in the Raleigh office of Ogletree Deakins. We are a law firm with over 50 offices throughout the country and internationally. We focus exclusively on representing employers across many industries, ranging in size from small businesses to Fortune 50 companies. And just FYI, in case you were curious, I have no relation whatsoever to any other attorney named Michael Cohen that you may or may not have read about it. So I'm here to talk to you today about wage and hour compliance issues for North Carolina businesses. And I understand that many of you are operating startups and small businesses. So I think this is a really great topic for all of you, because wage and hour is one of the few areas of employment law that is virtually certain to apply to your business, whether it's through the Federal Fair Labor Standards Act or the North Carolina Wage and Hour Act. Many other employment statutes really only apply to employers of certain sizes. So that and the fact that wage and hour is something that I personally enjoy, as strange as that might make me, makes up the bulk of my practice, and I've been practicing in the area since the start of my career. So I'm definitely looking forward to helping you all out. So let's just jump right into it. I know we only have about an hour, and we want to try to leave some time for questions at the end of the presentation if that's possible, but I do have quite a bit to cover. I'm going to start by providing just a very big picture overview of some of the key wage and hour compliance issues that all North Carolina employers should be aware of. This is certainly not an exhaustive list, but nonetheless, these issues include the payment of minimum wage for all hours owed or all hours worked, the payment of any promised wages and benefits for all hours worked, the payment of overtime wages for any hours worked over 40 in a work week, the determination of how to calculate overtime wages, the determination of what constitutes hours worked under federal and state law, the determination of who is exempt from the minimum wage or overtime requirements, the classification of independent contractors versus employees. I'll note that these laws only apply to employees, so this distinction is important. The prohibition on certain deductions or withholdings from wages, and employer record-keeping obligations. So honestly, I could probably dedicate at least an hour to each of these issues on their own. Some of these issues probably at least a few days. I'm really just going to provide a high-level overview of all these areas and hopefully give you enough information to allow you to be aware of and hopefully avoid any pitfalls as you move forward in your business. I'll start with the minimum wage. This one is fairly straightforward. The minimum wage rate under federal and North Carolina law is $7.25 an hour. This applies even if an employee is not paid by the hour. So if you pay an employee a salary or on a commission or piece rate basis or some other form of payment, you do need to ensure that the employee is earning at least $7.25 an hour for all hours. Unlike some other states, North Carolina municipalities, that is counties and cities within North Carolina, they cannot set their own minimum wage rates. So there's really only one minimum wage rate you need to be aware of if you have any North Carolina employees. You don't need to worry, for example, about how the minimum wage might look different in Raleigh versus Durham versus Charlotte, which does make compliance a little easier. Tipped employees, if you have any, are one of the key exceptions to the minimum wage requirement. Tipped employees only need to be paid a direct cash wage of $2.13 per hour, as long as that cash wage plus any tips received by the tipped employee bring the employee's average hourly rate to at least the minimum wage of $7.25 an hour. And that $5.12 per hour difference between the $7.25 and the direct wage of 213 is referred to as the tip credit. Now, if a tipped employee does not earn enough in tips to reach the $7.25 hourly rate when the tips are combined with the direct cash wage, then the employer is responsible for paying the employee the difference. I should mention that there are a number of other rules and regulations that apply to tipped employees that are kind of beyond the scope of this presentation, but as far as the minimum wage goes, the tip credit is one of the bigger issues. Let's move on next to promised wages and benefits. This is a North Carolina Wage and Hour Act requirement, not necessarily an FLSA requirement, but it will affect virtually all North Carolina employers. The basic concept is that even though the law only requires that employees pay the minimum wage and overtime to eligible employees, once an employer promises to pay wages above those amounts, those promises are enforceable under state law. So while the law only says that you need to pay $7.25 an hour, if you offer or promise somebody a rate of $20 per hour, you are required by law to pay that amount. And an important item to note, this is actually a product of a fairly new law just passed last year, is that employees must be provided written notice at the time of hiring of the amount of any promised wages and benefits, as well as the time and method of the payment. Previously, employers were permitted to give this notice verbally. Now it has to be in writing. Another issue to be aware of is that under the law, if you want to reduce the amount of an employee's salary, you need to provide notice at least one pay period before you make the reduction. This also changed fairly recently. It used to only be 24 hours notice that was required. And one more important concept here is that the default rule in North Carolina is that any earned PTO, vacation pay, commissions, and bonuses cannot be forfeited and must be paid out at the conclusion of an employee's employment unless the employer has a written forfeiture policy in place. So you need to put it in writing if you want to overcome the default rule. And that's definitely something that I see a lot of employers inadvertently overlook. We'll talk next about overtime more generally. Under the law, all non-exempt employees must be paid at a rate of 1 1/2 times their regular rate of pay for all hours worked over 40 in a work week. There is a bit to unpack here. We'll talk about who is exempt and who is non-exempt later on in the presentation. We'll talk about the regular rate and how to calculate overtime wages in the next few slides. But for now, you should know that when you're calculating the number of hours worked, you're doing it on a work week basis. And a work week is any fixed period of 7 consecutive 24-hour periods, and it is determined by the employer. It can be a calendar week. Many employers handle it that way, but it doesn't have to be. For example, it could be midnight on Wednesday through 11:59 p.m. the following Tuesday, really any other configuration that you could think of. And this is definitely something that should be spelled out in the employee handbook. So I mentioned in the previous slide that overtime premiums are 1 1/2 times an employee's regular rate. Now we talk about how to calculate the regular rate. The regular rate is the total amount of compensation paid to an employee in a work week, less any statutory exclusions, divided by the number of hours worked in the work week. And I lay out the statutory exclusions here. I do want to pause to note that I can spend a long time talking about these. There are a lot of moving parts here. And these items are often the sorts of issues and litigation in and of themselves. But for the sake of trying to cover everything within an hour, I'll go over that fairly quickly. Exclusions from the regular rate include discretionary bonuses, gifts, payments for time not worked, such as PTO, sick leave pay, show up pay, things of that nature. Expense reimbursements, perks such as gym memberships or parking benefits, profit sharing plans, stock options, retirement and insurance plan contributions, and overtime premiums. And that does actually include premiums for hours worked over 8 in a day or for weekend or holiday work if you as the employer choose to pay overtime premiums for that work. Everything else, including wages, including non-discretionary bonuses, including commissions, shift differentials, really any other form of payment is calculated within the regular rate as part of the total compensation. So once you know how to calculate the regular rate, calculating overtime becomes a bit easier, but there are a few moving parts. So I'm going to kind of quickly go through a few examples for calculating overtime wages using a few somewhat common pay structures. I'll start with salaried employees that have fixed schedules. The regular rate for these employees is the amount of the salary divided by the number of hours the salary is intended to compensate. Overtime is then calculated at 1.5 times the regular rate. So the example I provide here is an employee who earns a salary of $600 per work week, which is intended to compensate for 40 hours per work week. On the work week in question, the employer works 55 hours, so 15 hours of overtime, 55 minus 40. You would calculate the employee's regular rate by dividing the $600 salary by 40, which is the number of hours the salary is intended to compensate. That gets you to $15 per hour. Overtime owed is then 1.5 times the regular rate, which is $22.50 per hour, times the number of overtime hours worked in that week. So that's 15. That gets you to $337.50 owed for overtime wages, or $937.50 owed in total compensation when you account for the $600 per work week salary. And I'll note that for employees paid on an hourly rate, the math is basically even more straightforward. The regular rate is effectively just the hourly rate, and overtime is 1.5 times the hourly rate. So the next example I have up here is salaried employees who are paid a fixed amount regardless of the number of hours worked, and whose hours typically fluctuate from week to week. They can actually be paid at half of their regular rate for overtime hours worked, as long as there is a clear mutual understanding of that arrangement. And the reason for this sounds kind of counterintuitive to some people, but the reason is basically that you're effectively already paying them the one component of the 1.5 times the regular rate requirement, because the salary is intended to cover all hours worked. So math shapes up a little differently. Here I provide an example where an employee earns $600 per work week, regardless of the number of hours worked. And you could assume for these purposes that there's a clear mutual understanding to that effect. If the employer works 60 hours in a work week, the employee's regular rate is $10 per hour, which is 600 divided by 60. And then the overtime owed will be at half that rate, $5 per hour. And you calculate overtime owed by multiplying that by the number of overtime hours worked, which is 20. The employee will thus be entitled to $700 in total compensation, which is the $600 salary plus $100 in overtime. I'll provide two more examples of more common situations, and again, I'm just trying to kind of squeeze everything in. If you have an employee who is paid with commissions, the regular rate is calculated by adding together all compensation in the work week, including commissions. Remember, that's not one of those statutory exclusions that we talked about earlier, so we do include it. And then you just divide by the total number of hours worked in a work week. So the example I provide is an employee who's paid $10 per hour plus $400 in commissions in a work week in which the employee works 50 hours. So the employee's compensation will be $900, which is $10 per hour for 50 hours plus $400 in commission. The regular rate is then calculated by dividing 900 by the 50 hours worked in the work week. That comes to $18 per hour. Overtime is then calculated by multiplying half of the regular rate by the number of overtime hours worked. And the reason you're using half of the overtime rate for these calculations is, as I explained before, the way we did our math, you're effectively already accounting for the one component of the 1.5 times the regular rate requirement. Since our regular rate is based on 50 hours worked, not 40 hours worked, you can approach this math differently. But using this formula, you basically multiply half of the regular rate, which is $9 per hour, by the number of overtime hours to get to that $90 in overtime compensation. And then when you add that figure with the hourly wages and commissions, you get to a total of $990 in total compensation. And then the last example I have up here is for employees who are paid at different hourly rates. Really, the same logic applies here. You add together all the compensation paid and then divide by the total number of hours worked to get to the regular rate, and then compute overtime from there. So in my example, I have an employee who earns $8 per hour as a janitor and $10 per hour as a cook. The employee works for 20 hours as a janitor and 30 hours as a cook in a work week. The employee's compensation will be $460, which is 20 hours at $8 per hour plus 30 hours at $10 per hour. The regular rate is $920 per hour, which is $460 in total compensation divided by 50 hours worked. And then the overtime owed will be $46, which is half of the regular rate. Again, we've already covered the one and 1/2 requirement. And multiply that by the 10 overtime hours worked. So the total compensation for the work week is $506, which is $460 in hourly wages plus $46 in overtime. All right, so we've talked about how the minimum wage and promised wage must be paid for all hours worked, and how overtime premiums must be paid for all hours worked over 40 in a work week. The natural question that arises from there is what constitutes hours worked? In other words, what time spent by an employee is compensable and what time is not compensable. And there are a lot of issues surrounding the question of what constitutes hours worked. But some of the more common issues that come up from the compliance standpoint include those that are listed here on the screen. It's travel time, on-call time, waiting time, rest and meal breaks, training time, and unauthorized or voluntary work, quote unquote. I'll briefly touch upon each of these issues, and I'll mention again that these are issues that really can be explored for hours or even days. So please note that I'm really just hitting the highlights for purposes of this presentation. So starting with travel time, ordinary time spent commuting to or from work is not compensable. So whether your employee lives 5 minutes from your office or an hour away, whether the employee gets stuck in traffic or not, none of that really matters. That time is not compensable. An exception to this rule does apply if the employee is performing work while traveling. So if you have an employee that takes a bus or a train to work, and she performs work on her laptop while traveling, well, now the time spent traveling does qualify as hours worked, and the time is compensable. Travel during the workday is compensable. So if you have an employee start at one job site and then travel to another, or if the employee starts the day by picking up tools and then travels to a work site, all of that time is compensable. This is referred to as travel that's all in a day's work. Travel to or from another city for just a one-day assignment is generally compensable, though you may be able to deduct the time that the employee otherwise would have spent commuting to work on a normal day. And then travel to or from another city for overnight travel is generally compensable when it cuts across normal work. For on-call time, whether the time is compensable really depends on the degree of restrictions placed on the employee. The more onerous the restrictions, the more likely it is that the on-call time will be compensable. As is listed here, the key question is whether the employee can effectively use the time for his or her own purposes. The courts do look at other factors as well, such as the scope of any geographic limitations, the number and frequency of calls, and the employee's ability to maintain a flexible on-call schedule. So it's not a black and white rule. There are shades of gray, but to give you kind of a more generalized example, if you tell an employee that he must remain on your premises during on-call time, he probably can't use that time for his own purposes, and that time should be compensable. By contrast, if the employee is only required to keep a cell phone on and can otherwise be anywhere he wants and use the time however he wants, that time probably is non-compensable. Waiting time is not very dissimilar from on-call time, but it could basically be summed up in two parts. If an employee is engaged to wait, as in the employer is requiring the employee to be at work and wait for something to do, then that time is compensable. Think, for example, of a receptionist who is allowed to sit around and read a book or play solitaire online until somebody calls or enters the office. His time spent at work will be compensable, even though he's not actively performing work the whole time. He's effectively being engaged to wait. By contrast, time spent waiting to be engaged is not compensable. So this would be time that the employee is completely relieved from duty, unlike an employee who is waiting to be engaged. So for example, if you have a restaurant server who arrives to work early and she sits at a table until her shift begins, that's time spent waiting to be engaged. She's completely relieved from duty. So that time does not constitute hours worked. Meal breaks are generally compensable as long as they last at least 30 minutes. I'm sorry, they're generally not compensable as long as they last at least 30 minutes. If a meal break is shorter than 30 minutes, then it must be paid. Likewise, if a meal break does last at least 30 minutes, it must be paid if the employee is not relieved from all duties during the break. So if you have an employee who has to perform work during the meal break, even if the work is inactive, such as waiting for the phone to ring, then the employee is not relieved from all duties and that time should be compensable. There is some case law allowing some minimal and sporadic interruptions, but for your purposes, for compliance purposes, you try to ensure that employees are relieved from all duties in order to keep this time not compensable. Training time as a general rule is compensable. So when you have a new employee starting up and you make the employee go through training before beginning formal work, that time is all compensable. The only exception to this rule applies if these 4 criteria are met. They're listed on the screen. Basically, 1, when the training occurs outside of regular work hours. 2, when the training is strictly voluntary, and that includes not leading an employee to believe that he needs to attend the training. 3, when the training is not directly job related. And 4, when the employee does not perform work during the training. And then the last item I have up here is unauthorized or voluntary work. General rule, this is compensable, and you may be liable to pay it if you know about it, or if with reasonable diligence you should have known about it. At the end of the day, the responsibility to prevent unauthorized work rests with the employer. Employers are free to discipline workers for performing unauthorized work, but that work still has to be compensated. All right, so next we're going to talk about employees who are exempt from the minimum wage and overtime requirements that we've discussed. These employees are commonly referred to as exempt employees, and employees who are subject to the minimum wage or overtime requirements are commonly referred to as, you guessed it, non-exempt employees. In large part, the list of exempt employees is highly specific. There are a few broader categories that I'll go into in some more detail, but in no particular order, here are some of the employees on the narrower list of exempt employees as defined by the statute. Includes babysitters employed on a casual basis, certain agricultural employees, certain seasonal employees, commission sales employees for retail or service employers, companions for the elderly, computer professionals, drivers, drivers helpers, loaders, mechanics, domestic live-in employees, fishing employees, forestry employees for small firms, fruit and vegetable transportation employees, outside sales employees, salespeople, partsmen, and mechanics at dealerships, railroad employees, and taxi cab drivers. And this is really just scratching the surface. I don't think it's a good use of everybody's time to do a deeper dive into some of these more narrow exemptions. But I will note that these exemptions have a number of specific requirements that must be met. Some of them, for example, require that an employee earn a certain income. Some require that an employee work for a certain type of employer. But again, that's kind of beyond the scope of this presentation. What I will cover are some of the broader exemptions that are a bit more common. They're referred to as some of the white collar exemptions, and they may apply to, or I'm sorry, they do apply to executive, administrative, and professional employees. So we'll start with executive employees as the first of the white collar exempt employees that I mentioned. And to be an executive employee, an employee has to satisfy a 4-part test. Title does not matter. We see lawsuits brought all the time by people with the title assistant manager or something of that nature, and it really doesn't matter. All that matters is whether this 4-part test is satisfied, and I'll go through each requirement and then kind of unpack a bit. So the first requirement is that the employee must be compensated on a salary basis of at least $684 per week, which is equivalent to $35,568 per year. Salary basis effectively means that the employee is paid a fixed amount, regardless of any variations in the quality or quantity of the work. As a general rule, K-docking or deducting from an employee's pay, if an employee only works a partial work week or a partial day, could effectively defeat the salary basis and the exemption altogether. But I'll talk a bit more about that in the deductions portion of the presentation. The second requirement for executive employees is that the employee's primary duty must be managing the enterprise or a customarily recognized department or subdivision of the enterprise. Managing typically includes things like interviewing and training employees, setting pay rates, setting hours of work, directing the work to be performed, controlling the budget, things of that nature. The third requirement is that the employee must customarily and regularly direct the work of at least 2 or more other full-time employees or their equivalent. Equivalent could mean, by way of example, 1 full-time employee and 2 part-time employees. And then the fourth requirement is that the employee must have the authority to hire and fire other employees, or that the employee's suggestions on employment decisions, such as hiring, firing, advancement, or promotion, are given particular weight. And that applies even if there's somebody else that ultimately has to approve of the decision. And the last thing I want to note for executive employees is that business owners are also considered executive employees if they have at least a 20% equity stake in the enterprise and if they are actively engaged in managing the enterprise. So the next white collar exempt employees we'll take a look at are administrative employees. And this doesn't mean administrative employees in the more conventional sense, like someone who performs clerical tasks. To be an administrative employee under the FLSA, an employee needs to satisfy a few-part test that we have up here on the screen. The first requirement is similar to the executive employee requirement, but unlike the executive requirement, the employee can be paid on a salary or a fee basis of at least $684 per week. Fee basis payments are not super common, but they're essentially a predetermined and fixed amount for a single job that's unique in nature. The second requirement is that the employee's primary duty must be the performance of office or non-manual work directly related to the management or general business operations of the employer or the employer's customers. And management or general business operations is something akin to running or servicing the business as opposed to, say, selling a product or working on a line or something of that nature. So common examples include tax, finance, insurance, marketing, procurement, human resources, database administration, legal compliance, and similar activities. And then the third requirement is that the employee's primary duty must include the exercise of discretion and independent judgment with respect to matters of significance. And courts really focus on this factor. So if an employee is following a manual or a formula or is subject to heavy direction, or if the discretion and judgment exercised by the employee only applies to relatively insignificant issues, then there is a chance that the employee will fail the test and not be administratively exempt. And then the last of the white collar exempt employees that we'll take a look at are professional employees. And there are 2 types of professional employees, learned professionals and creative professionals. Both professionals must be paid on a salary or fee basis of at least $684 per week. Learned professionals also must have a primary duty requiring advanced knowledge in a field of science or learning with such knowledge customarily acquired through a prolonged course of specialized intellectual instruction. I provide some examples up here. They include doctors, registered nurses, lawyers, dental hygienists, CPAs, teachers, and pharmacists. And I do note that there are special rules in place providing that doctors, lawyers, and teachers do not need to meet the salary basis or salary level tests to be exempt. And then creative professionals must have a primary duty of performing work requiring invention, imagination, originality, or talent in a recognized field of artistic or creative endeavor. And some examples I provide up here include musicians, composers, painters, photographers, actors, and playwrights. And the last thing I want to mention on the subject of exempt employees, particularly exempt white-collar employees, is that highly compensated employees are also deemed exempt if they perform office or non-manual work, and if they customarily and regularly perform at least one of the duties that we discussed of an exempt executive, administrative, or professional employee. And to be highly compensated for purposes of this exemption, the employee needs to earn at least $107,432 in annual compensation, which should be inclusive of at least $684 per week on a salary or fee basis. All right, moving on, I want to spend a little time talking about independent contractors because it's really such a prevalent issue in wage and hour law, both in terms of compliance issues and litigation as well. And I want to make one very important point from the get-go. And I think if you take nothing else away from this presentation, you should take away that whether a worker is an independent contractor or an employee is not up to the parties. Even if the worker agrees, even if the worker prefers to be classified as an independent contractor, that's effectively immaterial. The determination is made by law based on the facts and circumstances of the parties' relationship. And sometimes folks argue, well, we give the worker a 1099, or the worker has an employer identification number, or the worker is called a consultant or calls himself a consultant, or this is common industry practice, or we sign an independent contractor agreement. All of those may help. They certainly won't hurt, but they are not dispositive on their own. They alone will not make somebody an independent contractor by law. What courts focus on in determining whether someone is an independent contractor as opposed to an employee is what's referred to as the economic realities test. The economic realities test requires weighing 6 factors, none of which are dispositive on their own, but all of which are kind of considered and weighed against each other. And ultimately, courts are trying to determine whether, as a matter of economic reality, the worker is an employee or an independent contractor. So I have the factors up here on the screen. I'll just kind of take them in order. The first asks whether the work performed is an integral part of the hiring party's business. If the answer is yes, the worker is more likely to be an employee. And if the answer is no, the worker is more likely to be an independent contractor. So think, for example, of a call center that hires workers that it calls independent contractors, but they're basically being hired to answer phones. Courts are going to look at that and say that answering phones is an integral part of the business of a call center. So that certainly looks more like employment. And then if you kind of contrast that with the same call center hiring somebody to clean the facility, that work is not an integral part of the business, and therefore it looks more like an independent contractor relationship, depending on some of the other circumstances. The second factor courts take a look at asks whether the worker's opportunities for profit or loss are dependent on his or her managerial skill. If the answer is yes, then it is more likely that the worker is an independent contractor. And if the answer is no, then it's more likely that the worker is an employee. And the reasoning for this is basically that independent contractors more often need to market their services and negotiate contracts and decide which jobs to perform, decide how to perform the jobs, decide whether to hire other workers of their own, and things of that nature. Whereas employees usually don't make these kinds of decisions. So in that regard, like I said, if the answer is yes, it looks more like an independent contractor. If the answer is no, it looks more like an employee. The third factor courts look at under the economic realities test is how the worker's investment compares to the hiring party's investment. So the greater the relative share of the worker's investment, the more likely it is that the worker is an independent contractor. And obviously, the contrast of that is the lower the investment, or in most cases, if there's no investment, it looks more like an employment relationship. The fourth economic realities factor is whether the work requires special skill and initiative. So if the answer is yes, the worker is more likely to be an independent contractor. If the answer is no, then the worker is more likely to be an employee. Obviously, that doesn't mean necessarily that if there are special skills required, that the worker is automatically an independent contractor, or if there are few skills required, that the worker is automatically an employee. But like I said, this is one of the several factors that the courts weigh, none of which on their own is positive. And this factor is kind of looking to some extent to the worker's use of his or her own independent judgment. The more skill and independent judgment that a worker exercises, the more the worker looks like an independent contractor. The fifth factor under the economic realities test is whether the relationship between the worker and the hiring party is permanent or indefinite. If the answer is yes, then the worker is more likely to be considered an employee. If the answer is no, then the worker is more likely to be an independent contractor. So if you have somebody that's coming in every day and as far as the parties are concerned, that relationship is just going to kind of extend indefinitely, that looks a bit more like an employee as opposed, that looks a bit more like an independent contractor as opposed to an employee or an independent contractor who you might have, say, a 1 month or 6 month or some other kind of fixed relationship with. And then the sixth factor under the economic realities test is what degree of control does the hiring party have over the manner in which the work is performed. So the greater the degree of control, the more likely it is that the worker is an independent contractor. And you could think, when I hire an electrician or a plumber to do something, I'm not controlling how they do their job. I'm deferring to them. And that certainly looks a lot more like an independent contractor relationship. An employee, by contrast, I'm exercising control over how the work is performed. So you can kind of think of it that way. The next item we're going to take a look at are deductions and withholdings. And I'm going to point out some of the key principles here. Again, this is something I could spend a lot more time discussing, but I'm going to try to limit myself to kind of the higher level issues. So first, deductions that reduce an employee's rate of pay to an amount below the minimum wage rate or owed overtime wages are prohibited. For example, if you have an employee who earns $8 per hour, you can't deduct an average of more than 75 cents per hour because that'll effectively bring the employee's wages below the minimum wage rate of $7.25. So if the employee works for 40 hours in a work week, the most you could deduct is $30 in that work week because that equates to 75 cents per hour. If you deduct more than that, you're effectively lowering the average rate to below the minimum wage. The second thing that you should know is that written authorization is needed before deductions may be made under state law. And generally, this requires a statement of the reason and the amount of the deduction. In some cases, like when the deduction is for a loss or damage or a cash shortage, then the employee must receive at least 7 days notice before the deduction is made as well. Or when the deduction is for the employee's benefit, the employee must receive at least 3 days to withdraw authorization. The rules do vary a bit and are somewhat beyond the scope of this presentation, but as a general rule, you do want to make sure you obtain written authorization before deducting from an employee's wages. And then I have up here exceptions to the written authorization requirement under state law. Those include overpayments of wages as a result of a miscalculation, advances of wages, principal loan repayments. So just the principal loan, it excludes interest and other charges on a loan, which do require authorization, and cash or inventory shortages or loss or damage to an employer's property if the employee is arrested or otherwise following criminal process for related reasons. However, if you do deduct for that reason and the employee is ultimately found not guilty, then any amount deducted would need to be paid back. All right, so I mentioned earlier when we talked about exempt employees that docking an employee's pay could effectively defeat the notion that the employee is paid on a salary basis and therefore defeat the exemption entirely. There are a few exceptions to that general rule, which is often the case in this industry. In no particular order, those include 1, full day absences for personal reasons other than sickness or disability. And I do want to note here that partial day absences could be deducted if they're effectively paid out anyway by virtue of PTO or vacation pay or something similar. But just as an overarching rule, full day absences for personal reasons are the only exception. All right, so number 2, full day absences for sickness or disability when the employer has a paid leave plan in place that compensates the employee, and that applies even if the employee has already exhausted those benefits. Number 3 include full day absences due to disciplinary suspension for violating written workplace conduct rules. Number 4 is absences that violate safety rules of major significance. Number 5 are absences pursuant to the FMLA. Number 6 are deductions designed to offset military pay, witness fees, or jury service fees. So I do want to note that that's not necessarily deductions for serving as a witness or taking time to serve on a jury, but just to offset the fees or pay that somebody might receive in exchange for performing that service. And then number 7 is if the employee works less than a full work week during the first or last work week of employment. All right, and then I will kind of conclude this presentation with an overview of employers' record-keeping requirements. As you can see on the presentation, the following records need to be maintained for all non-exempt employees. Those include 1, the employee's full name and address, 2, the employee's social security number, 3, the employee's date of birth if the employee is under the age of 19, 4, the employee's sex, 5, the employee's occupation, 6, the time and day that the employee's work week begins, 7, the hours worked each workday and each work week, 8, the basis upon which the employee's wages are paid. So, for example, I have up here $10 per hour or $440 per week, or if you pay on a piece rate basis or any other basis, that should be recorded. 9, the regular rate of pay when overtime hours are worked. 10, the total daily or weekly straight time earnings. 11, total overtime earnings for each work week. 12, additions to and deductions from wages. 13, total wages paid each pay period. And 14, the dates of payment and corresponding pay period. And I get asked sometimes, how long do we need to keep these records? Under the law, it generally varies between 2 and 3 years, but as a matter of compliance, I typically advise employers to maintain these records for at least 3 years, because if there is any lawsuit filed related to your wage and hour practices, there's a chance that an employee will be able to look back as far back as 3 years, and you just want to make sure that you have everything you need to defend yourself if that does occur. All right, so that is the conclusion of my presentation. Thank you all for attending. If we have any questions, I'm happy to take them. Otherwise, you can always feel free to reach out to me directly. My email address and phone number are listed on this slide.
Excellent. Thank you so much, Michael. If anyone has questions, I ask that you please post them in the chat, and I will ask them to Michael if there's any questions at this time. All right, well, this presentation will be posted to our website following this recording. Thank you all so much for being here. Thank you, Michael. That was fantastic. I hope you all have a great day.
Thank you.